if you take a look at 2018, what we can learn from this past year is that for all the concerns about trade policy and Brexit, those weren't the real drivers of the big moves in the market. They drove volatility, but the big down moves in February and again catalyzed in October were about interest rates and inflation tied to Fed policy. Those are the indicators we want to watch. And that brings me back to the yield curve. You talked about that earlier in the program, watching for that inversion, which could perhaps take place next year, often a sign of a signal of the peak in the stock market. And there's one other gap to keep an eye on. That's the gap between the unemployment rate and the inflation rate. When those two become the same number, it's been a sign of the peak in the stock market ahead of a recession in the past.
Yes, this inverted yield curve, which I suspect, I'm just using my powers of intuition, will be something that we talk about in this network going forward the next couple of days, hours, days, and weeks. How severe is this, Jeff? I mean, how big of a, is it a red flag? Is it a giant cannon? What is this?
Well, the yield curve, when we see the 3-month yield rise above the 10-year yield, this has happened about 7 times in the last 50 years. It has a flawless track record in predicting a peak in the stock market, usually within a month or two of that inversion, ahead of a recession that often follows about a year later. This is a remarkably accurate indicator, but not just for U.S. stocks, even though we're looking at the U.S. yield curve. It works internationally as well. It's marked every peak in the EFI index since 1969 when that index was created. So it does a very good job of signaling peaks in the market. I realize that the yield curve is looked at as being distorted today by central bank policies around the world, yet it's continued to work in many countries, even though they've seen their yield curves entirely below zero for periods of time, as they have in Switzerland, for example.
Yeah, certainly is the case. And how do you think this trade thing plays out, Jeff? I mean, the market swung wildly yesterday based on a couple of headlines. I think people have kind of dove into it a little more, and we're like, what's Charles Schwab's view on this trade truce, if you will?
Yeah, well, it's a bit of a one-hit wonder so far, one-day wonder so far. Obviously, nothing was resolved. We'll have to keep an eye on it closely, but there are reasons to believe that ultimately we might come to some kind of agreement, not just because we came to an agreement with Korea and their FTA this year or on NAFTA, but look, we've seen the EU and Japan join with the U.S. on WTO complaints lately, so that adds weights to the U.S. demand on some of these structural issues like technology transfer and intellectual property that China knows it's not just negotiating with the U.S., but the rest of the developed world. There are other factors as well. For example, obviously, we've got China very focused on its Made in China 2025 program. That wasn't mentioned at all, so China can still lend some support there. There are a variety of factors that could cause both sides, I think, to come to the table, come to some sort of agreement, but they're far apart, and 90 days isn't a lot of time.